No matter how optimistic you are about the economy and its ability to recover by the end of this year, as predicted by the central bank in early June, the sustained surge in the rate of inflation is bound to spur on the skepticism that accompanied similar announcements from Treasury.
I'm not too sure that food prices will reduce like today or in the next few days.
In June last year, inflation stood at 3.49%, but has steadily risen to the current 14.49%, way above the central bank's desired level of 5%, meaning that prices of basic commodities such as maize flour and sugar are now out of reach for many Kenyans. These commodities have been largely affected by a weak shilling, which hit a 17-year high of 92 shillings to the dollar early in the month, raising the cost of most commodities with an import component. This has in turn piled pressure on interest rates, with banks increasing their lending rates to compensate for inflation and the risk of default.
We are concerned about the high rates of interest, and we are indeed appealing to banks, and we are also asking central bank to work with our commercial banks to see how we can bring these levels of interest down.
In response to this, the central bank on Wednesday notified commercial banks that it had ceased the application of the central bank rate or CBR to loans and replaced this with a higher rate for its overnight discount window, which at 8% is higher than the CBR's current 6.25%. The regulator has also forbidden the use of funds from the overnight window in interbank or foreign exchange trading. The move is expected to rein in inflation and bolster the shilling, and will see CBK review the new interest rates regularly and post them on its website by 9 a.m. daily. Wanjiru Gaitho, Citizen Business.